hedging inflation risk. How much of a challenge now is coming from the bond market?
I think it's a meaningful challenge, Jonathan. You know, when you're in the investment business and you're at a cocktail party and someone asks you for advice or stock tips, the good thing to say is always stay invested, stay diversified. But right now I would say stay invested, stay diversified, hedge inflation risk. My message to our clients is diversify your hedges. Lisa has hinted at this. Treasuries won't do the job if we get inflation volatility. We like a portfolio of hedges. We like to hold cash, be short duration. We like real asset equities, energy companies, metal companies. We actually like hedged equities. You know, buy protection and then you can still participate in the rally. You give up part of the upside. But what you end up with is a diversified set of hedges while staying invested, because you know what? The earnings, Jonathan, you've been talking about this on the show all week. They're amazing. We thought we'd get 13% year-over-year growth at the end of March. We're trending at 30% year-over-year growth. Those are massive, massive earnings surprises. So stay invested, stay diversified, hedge inflation.
Seb, I totally agree with you. And you and I have been talking about this over the last several months, the journey of the last 2 to 3 months. We had the energy shock. At times, we started to see a rate shock emerge. We're seeing that again, globally, not just in the US and Japan and the UK. Is that going to translate into a growth shock? Do you think we can withstand the latter?
You know, if you do get a growth shock, you will want treasuries. I'm not saying you should just remove all treasuries from your portfolio and just put all this in gold. It's a diversified set of hedges. But Jonathan, you frame this first as a chain reaction, and it's a slow-moving chain reaction. And I really liked how you framed it, right? You were talking about an oil shock that leads to an inflation shock, that leads to a rate shock, that eventually tightens financial conditions, and that leads to a growth shock. I'm not too worried about the growth shock because the underlying U.S. economy is running, it looks like, at 6% nominal growth right now. And the economic surprises are trending up, not down so far this year. But this is the main risk in financial markets, Jonathan. It's the collision course between inflation and Fed policy. And you know, Jeff Gonlach will say, the way you look at this collision course, what could force the Fed's hand, despite all the politics that are going in the background, is the 2-year yield.